Hey, good morning, folks. Welcome here on this slippery, blustery day. Glad you all made it. I'd like to call the meeting of the Standing Committee on the Alberta Heritage Savings Trust Fund to order and welcome you all. My name is Ron Orr, the MLA for Lacombe-Panoka and chair of today's committee meeting. So I'd like to ask members and guests at the table to introduce themselves for the record, and I'll call on those on my right to begin, and then after we've done the table here, I'll go online. So,
thank you, Mr. Chair. Good morning. Tracy Allard, MLA for Grand Prairie and the Deputy Chair of the committee.
Good morning, Mr. Chair. Grant Hunter, MLA for Tabor-Warner.
Good morning, all. Amit Prakash, AIMCO, Chief Fiduciary Management Officer.
Good morning, Steve Thompson, Treasury Board and Finance, Executive Director of Capital Markets.
Good morning, Brittany Jones, Senior Manager of Portfolio Analytics and Research in Capital Markets at Treasury Board and Finance.
Mr. Chair, if I may just for a moment, Evans et al., our CEO, would be here momentarily, so he'll introduce himself then.
give him an opportunity to introduce himself when he steps in. Thank you.
Good morning. My name is David Egan. I'm the MLA for Edmonton Northwest.
Good morning, Christina Steenbergen, Supervisor, LAO Communications.
Good morning, Rhonda Sorensen, Manager of Communication Services.
Good morning, Nancy Robert, Clerk of Journals and Committees.
Good morning, Warren Huffman, Committee Clerk.
Wonderful. Online, I'll maybe call your name. Yeah, I see Ms. Phillips right away came online. So, Ms. Phillips, please.
Shannon Phillips, MLA for Lethbridge West.
Josephine Pond, I see. Sorry, you're muted. I can't hear you.
It again. Good morning, everyone. Josephine Pond, MLA for Calgary Bennington.
Thank you. Ms. Isaac.
Good morning, Whitney Isaac, MLA for Calgary Glenmore.
Mr. Gottfried.
Good morning, Richard Gottfried, MLA for Calgary Fish Creek.
Pardon me? And I think that's it online. So wonderful. Welcome, everybody. And congratulations, everybody, for attending. We don't have any substitution today, so good for all of you. A few housekeeping items to address excuse me, before we begin our business. Please note the microphones are operated by Hansard staff. You don't have to touch them. Committee proceedings are live streamed on the internet and broadcast on Alberta Assembly TV. The audio and video stream and transcripts of meetings can be accessed via the Legislative Assembly website. Those participating by video conference are encouraged to please turn on your camera while speaking and mute your microphone when not speaking. Members participating virtually who wish to be placed on the speakers list are asked to message the committee clerk. You can do that on the Teams app there, either raise your hand or messaging. And members in the room, please just signal myself or the clerk and we'll get you on the list. Make sure your phones are off, other devices are silent, and we'll proceed. So let's begin with the approval of the agenda. A draft agenda was circulated on the site. Anybody have any changes or additions to the agenda? And if not, would someone make a motion that the Standing Committee on the Alberta Heritage Savings Trust Fund approve the draft agenda for today's meeting as distributed? So moved. Any discussion? None. In the room, all in favor? Aye. Any opposed? Online, all in favor?
Aye.
Aye.
Any opposed? None, so that is carried. Thank you very much. And we can move forward. Approval of the minutes from the last meeting, September 26, 2022. Any members have errors or omissions to note? And if not, would someone move that the minutes of the September 26, 22 meeting of the Standing Committee on the Alberta Heritage Savings Trust Fund be approved as distributed? Mr. Egan has so moved. Comments or questions? Seeing none in the room, all in favor? Aye. Any opposed? None online, all in favor?
Aye.
Aye.
And anyone opposed? Seeing none, that is approved. So I think I will take just one moment and allow our latest participant to introduce himself. Thank you. Don't want, just for the record, thank you.
Thank you, Mr. Chair. I'm Evan Siddall. I'm the CEO of AIMCO.
Thank you and welcome. Glad you could make it, and we'll proceed. So, the Alberta, the second quarter report is the business at hand. Alberta Heritage Savings Trust Fund second quarter report for 22-23 was released on November 24th of this past year, November of 22. Members were notified when the report was posted on the committee's internal website. As committee members will be aware, the Alberta Heritage Savings Trust Fund Act mandates that one of the functions of this committee is to receive and review the quarterly reports and the operational results of the Heritage Fund. So we're pleased to have the representatives from AIMCO and Treasury Board and Finance here. They've introduced themselves already to provide us with an overview of the report and answer any questions that you as members may have. So I'll turn the floor over to AIMCO and TBF. And please begin when you're ready, whoever is going to start.
Thank you, Mr. Chair. As stated, I'm Steve Thompson, the Executive Director of Capital Markets. With me in the room today is Brittany Jones, our Senior Manager of Portfolio Analytics and Research. We're here on behalf of Lowell Epp, the Assistant Deputy Minister of Treasury and Risk Management, who is with the Minister today and unable to attend. Thank you for having me here, and happy to present the second quarter results of fiscal 22-23 ended September 30th, 2022. I'd like to begin by reminding everyone of the mission of the Heritage Fund, as stated in the Act, which is to provide prudent stewardship of Alberta's savings by providing the greatest financial returns on those savings to the benefit of all Albertans. The Alberta Heritage Savings Trust Fund Act states that the investments of the fund must be made with the sole objective of maximizing long-term financial returns, and when making investments, to avoid undue losses and obtain a reasonable return that will enable the fund to meet its stated objectives. At TBF, we are tasked with helping to ensure that the fund is well positioned to meet its stated goals and that it abides by the performance and risk constraints set out by legislation. The fund experienced a challenging second fiscal quarter. High levels of inflation continued to be of concern, while the potential for a global recession clouded investor optimism and performance. The war in Ukraine also continued to disrupt and negatively impact global trade and commodity prices. Over the quarter, returns for the fund were a negative 0.1%, almost zero, but not quite, although this was better than the negative 4.1% recorded in the first quarter. The market value of investment assets was not impacted over the quarter, but has fallen from $20 billion at fiscal year end March 31st, 2022 to $19.1 billion at the end of September 2022. Returns in assets under management may have been flat, but the quarter was by no means dull. The MSCI All Country World Index is a measure used to monitor the performance of a broad set of global equity returns, which is often used as a rough proxy for global investment performance. Between June and mid-August of 2022, this return rose 10.6%, only to fall by 10.3% by the end of September. As a result, performance returns over the quarter were flat, but markets experienced considerable volatility throughout. By quarter end, the long-term asset mix of the fund was comprised of 19.7% fixed income securities, 34.1% inflation-sensitive and alternative assets, and 45.8% in equities. The remaining 0.4% of the holdings was comprised of strategic opportunities of the fund. This asset mix is in line with our expectations given recent market activity. The rapid rise in interest rates over the past year has also affected the performance of the portfolio negatively. Falling interest rates in prior years have had a positive impact on the valuation of assets, and we witnessed high returns in fixed income and a rally in equity markets. What we have been witnessing since the start of the fiscal year is that interest rates reversing course and steadily increasing. This, as you would expect intuitively, has the opposite, a negative effect on returns, and tends to push valuations of assets lower. The inflation-sensitive asset classes held by the Heritage Fund recorded positive absolute returns for the fiscal year to date, as at September 30, 2022. These asset classes include real estate, infrastructure, and renewable resources. These types of investments are able to add value during inflationary periods because they generate cash flows that adapt to the changing inflationary environment. This is important to the Heritage Fund as its annual growth target is inflation-based. This target is for the fund to earn the Canadian Consumer Price Index plus 4.5%. As inflation continues to creep up, it does push this benchmark higher, but at a relatively slow pace, due to the fact that the target is measured on a 5-year rolling average basis, which captures changes in the level of inflation gradually by design. Prior to the pandemic, this 5-year CPI plus benchmark, as we refer to it, was 6.1%. Since then, the target has increased by 40 basis points, or 0.4%, to end the second quarter at 6.5%. As described, the portfolio is designed to work in many differing economic environments, including periods of inflation. However, there are times when performance will fluctuate both above and below the return target. Over 5 years, the Heritage Fund has returned 6.2% annually, which is slightly below the current real return target that I've just referenced. Investment income has been slightly negative to quarter end with a loss of $2 million. But the losses reported for the first quarter of $64 million have been almost fully recouped over the second quarter. This means that as of September 30th, 2022, there was no income to be retained within the fund for inflation proofing or other purposes. However, income is accumulated throughout the fiscal year with the final results calculated as of March 31st, and it is possible that the fund's positive trends throughout the second quarter will continue. Thank you, Mr. Chair and the members of the committee. That will conclude my prepared remarks. We're happy to take questions when appropriate.
We'll continue with the Heritage Savings Trust Fund, folks. Mr. Siddle?
Yeah, I'll just make a couple of comments if I may, and my apologies for being late and not wearing a tie as I would want to do. I was at the dentist. I was making myself a little more comfortable, so thanks for understanding. You know, this is kind of an odd discussion. We're pretending we're 4 months ago, looking back 3 months, and here we are at the beginning of a year looking forward, and we're spending a lot of our time looking forward. In market environments that are difficult, with inflation higher than we want it to be, war in Europe, supply chains interrupted, and a lot of sort of clouds on the horizon. You will have questions, therefore, about our performance. We're much more oriented towards thinking about the future, of course, at AIMCO, and how we position ourselves for the long term. As Stephen said, we think of ourselves over a 4 or 5 year period, and that's how we really look at our performance. Although we will, of course, respond to your questions. As we think about the long term of the organization, we have, you know, from last time I was here, we have a new corporate strategy, one that's focused on clients, on an adaptive investment platform that reflects the differences among our clients, and building a leadership team and a culture that is united and in service of our clients. We've made some good progress in that respect. We have a leadership team now that's fully in place with a new Chief Investment Officer, Marlene Puffer from CN Rail Pension, and another senior executive from PSP joined us recently as well. As we position ourselves for the future, we've also, we're sharing now with our clients a new investment strategy, one that is based on our true sources of edge, including the scale of the organization, the fact that we think we can be a preferred partner, and we're also looking at diversifying for the benefit of our clients by having new international offices in Singapore and New York, which we will open this year. That's sort of the path we're on. The organization is much, much stronger than it was 2 years ago, much more united. We're operating from a client perspective, looking at their portfolios, as opposed to from an AIMCO organization, looking at things as a collection of products. That actually is quite important to how we invest on our clients' behalf. You know from when I first started that making clients our first priority has been something that's strategic and important, and that of course includes the Heritage Fund. So we are happy, Amit and I are happy to respond to your questions. I'll take any of those that are strategic and probably forward-looking, and Amit has the detail from looking backward from September.
Okay, well, thank you very much, sir. Can I assume from both of you that you spoke on behalf of the others at the table? That's we can go to questions directly?
As far as I'm concerned,
yep.
Yeah.
Okay.
Yes.
Comments to make? No?
No, yeah, we'll address them through the Q&A. Thank you.
Okay, perfect, thank you. Okay, so members, it's time for your and thank you folks for your presentations. It's time for questions. I would just remind us, as kind of already been alluded to a little bit, that we're looking at a quarterly report that it's been in the past, and yet here we are in a new year. And but the focus is the quarterly report before us, and of course that includes the presentation that you've heard. So questions with regards to any of this before us, I'm ready to receive, and I understand that Ms. Phillips has her name on the list first, and then after that I'll go to Ms. Isaac.
Thank you, Mr. Chair. So we had a bit of back and forth over the last quarter. The government's second quarter fiscal update, the Minister of Finance said the government would be depositing money into the Heritage Fund, and it was set to be roughly 20 billion after those deposits. And then we got a new premier. That decision was reversed, and there was no deposit into the fund. So can the ministry then share some additional insight into that decision making? What at Q1 was the forecasted incremental new revenue from the Alberta Heritage Fund? And can you share any of the analysis that went into reversing that decision?
Ms. Phillips. So this has been an interesting decision. This has been something that has been on our plate for a long time and something that we have done a lot of analysis around. The legislation has not yet been changed, so the assumptions that we're working with right now are those that are stated in the Act. We have put out a new investment income forecast that you will see in the upcoming fiscal, or that has been published as well too in the plan. The decision has not yet been put down on paper formally as far as the legislation goes, but it is in the works. When we talk about the market value of investments, and then when we talk about the net assets as well, so that's actually in the financial statements right at the beginning. There is a receivable that's in there, and so that talks about what we're going to do with that investment income. The plan going ahead is such that we want to focus on the strength of this plan going forward and building up these investments.
Sure. And the department, in terms of managing the fund and in terms of what is retained versus what is withdrawn from the fund, is constrained by the current legislation. So we will be guided by any changes made to the Act in the coming legislative sessions.
Okay, thank you. Follow up, Ms. Phillips, or no?
Yes, please. So let me try again a little bit. What analysis did TBF provide to the government at Q1 that changed at Q2 to reverse that decision? What was the underlying professional public service analysis on either the return on investment or the foregone revenue that was provided to Treasury Board in order to reverse itself in a matter of months on that multi-billion-dollar decision?
Nothing specific that I'm aware of was done in terms of an analysis. The analysis is basically whether you earn a higher return by leaving funds in the fund, in the Heritage Fund, or by withdrawing them. That analysis hasn't changed in the entirety of the fund's existence. I'm unaware of anything that specifically is guiding those decisions.
Okay, thank you, sir. Ms. Isaac.
Good morning. You spoke a little bit earlier about inflation and its effect on the fund, but more specifically, you sort of spoke about different assets and how they react with respect to inflation. On the first page of the report, you talk about the annual growth target being CPI plus 4.5%. With inflation being what it is now, which is, from my recollection, is the highest it's been in probably, I don't know, at least 20 plus years, maybe 30 years. That's a pretty lofty goal, 4.5% over CPI. So could you talk a little bit about the investments or the fund's investments that, let's call it, that are inflation hedged? And then can you also just speak a little bit about the performance of the sort of inflation hedged assets you mentioned earlier, like real estate and some others? How do those assets compare to the sort of non-hedged assets in this year and in the years where inflation was within the 2% Bank of Canada target rate?
Thank you. Thank you very much for the question. Inflation certainly has been front and center for us as we think about the strategy on behalf of the Heritage Fund, and certainly across the market. So let me preface it by saying that our outlook looking forward is for mild stagflation, i.e. Lower growth with elevated levels of inflation. Within that context, the first line of defense, and you've heard us say that before, is the design or the asset allocation of the Heritage Fund. So to the extent that it has about a third of the allocation to inflation-sensitive exposures, that's been very impactful, particularly over the recent past, but even as we look forward. More specifically, as we break that down, the infrastructure and renewable exposures have done really, really well, and both are up over the recent past in double digits, significantly ahead of public markets. And so over the last 12 months, both renewables and infrastructure are up between 19 to 30%, so really attractive returns. And likewise, real estate up almost 12% for the 12-month period under September 30th. A few other things, and particularly, I think as Evan mentioned, what we're focused on is the future, and using certainly past as a roadmap in terms of learning about the markets as we go along. So one of the areas that the Heritage Fund and we've built capabilities on is our renewable resources. And to just give you a bit of color, why this is attractive. Under renewables, on your behalf, we invest in agriculture, in timberland, and what it does is that these types of exposures have commodity-like aspects to it, and some of the recent ones that we've made, for example, in Australia, in Lawson Grains, the impact on the crop prices, the impact on the real estate, on the land, underlying land, both of those exposures have become quite attractive. One more example, within a real estate portfolio, we've been adding exposure to industrial opportunities. Across Canada, we're at a multi-decade low in terms of the availability of those types of facilities. And again, that's quite attractive as we look forward relative to where we've been. And the last bit I'll say is, in addition to all of these positioning and how we are positioning the portfolio as we look forward, is the work that we've also become quite intentional and focused on, which is providing a research framework where these decisions and these trade-offs can be made in a sensible and optimal manner. Thank you.
Thank you very much, Mr. Prakash. Follow-up.
Thanks, Chair. I just wanted to maybe catch that last point. Can you talk a little bit about, going forward, how the fund plans to sort of, or if the plan funds to rebalance the portfolio at all between, sort of inflation sensitive or inflation successful, let's call it, assets and other assets that either don't react to inflation or react less well to inflation. Can you, I guess my thought pattern here is what goes up at some point will come down. How are you planning? How is the fund sort of planning to react to that?
Sure, happy to answer that. It's part of our responsibility when we talk about management of the fund. We are actually in the midst of conducting an asset mix review of the plan's asset allocation, which involves doing financial modeling of expected returns in various scenarios, including the current inflationary environment. It has been quite some time since an extensive allocation study of this type has been done for the fund. We have reviewed it internally. We have built some models using AIMCO's capabilities and in conjunction with AIMCO. We are in the process of potentially contracting with an external service provider to do an extensive asset allocation review of the fund to provide us with an independent opinion and advice on the appropriate asset allocation for the fund going into the future. So please.
And then just one other point that I'd like to add is that you do make, that was a wonderful question about what goes up does come down. We are able to make slight portfolio adjustments along the way, and we have done that. So there are times where AIMCO does come to us with some tactical decisions that could benefit the fund in our favor for either the long run or the short run. And over the years, so 2011 was the first time, or was the last time that an external service provider had really done the deep dive independent analysis. Since then, we've done multiple small little adjustments to the portfolio. So just recently, we updated a new statement of policies and goals on the website. And what you'll see there is there has been an adjustment to the upper bound with private debt and loan. So there's not necessarily been a change right now, but what we've done is we've amended those ranges so that when AIMCO sees the tactical ability to take advantage of some of those opportunities, they're able to do so. Hopefully that helps your question.
Thank you very much. And with that, we'll move on to Member Egan, please.
Well, thank you, Chair. And my question is to TBF, please. We already heard that one of the targets of the Heritage Trust Fund is to deliver returns of CPI plus 4.5%, right? At the Q2 update, as we already knew, the Premier decided to reverse the decision to deposit quite a lot of billions of dollars into the fund. So I guess conventional wisdom, I'll ask the question to respect that, might question, are we better off paying down the debt with the surplus, or whether we're better off saving that amount in the Heritage Trust Fund and earning a return? Obviously, the former Premier and the current Premier had different views on this, but I'm curious to know, as a professional civil service, I'm looking for more clarity to your previous answer to the member from Lethbridge West. Was the decision to reverse saving a portion of the surplus really made without any analysis given by TBF officials? Was there no analysis of the ramifications of the decision sought by the Premier or the Finance Minister or anyone else in the new administration? Question.
Sure. And fair question. And sort of to clarify my answer, our division, our group, is responsible for the oversight of the investment policy of the Heritage Fund. Your question is broader in scope and speaks to overall fiscal policy decisions on debt repayment versus contributions to the investment portfolio. Obviously, we do have input into what the potential returns on the investment portfolio would look like, and we would be the ones tasked with calculating the impact of reducing the debt on debt servicing costs and therefore the fiscal balance going forward. So those calculations, those are done constantly at the department level, and that information is constantly provided to the Minister and Cabinet, Treasury Board, and appropriate decision makers. What I'm not aware of is what is then done with that analysis. I am not privy to Treasury Board decisions. I am not involved in Cabinet decisions, and I cannot speak to those decisions having been absent from the room. But yes, we do provide calculations on what the impact of reducing outstanding debt on the province will be, and we will provide forecasts on what investment income would be based on the levels of the fund and expected returns.
And the returns from the Heritage Fund right now have been higher than the debt servicing costs.
Thank you both. And a follow-up, Mr. Egan?
Yes, thank you, Mr. Chair, and to Mr. Siddall. I just wanted to ask you, I mean, you know that you see those bond rates out there, and you see the government of Alberta shifting positions dramatically in the last few months. Big deposit into the Heritage Trust Fund and then no deposit at all. And so at the end of the day, the government makes the decision. I understand that, of course, but you put your technical analysis perhaps to use. What would be the return of the investment for the last quarter had we made a deposit into the fund? Can you provide analysis? Surely there was some provided to the government, as Treasury Board and Finance just said they did. Was presented at least internally when the government initially announced that they would be making a deposit into the fund. So regardless if the government chose to act on that analysis, I mean, which would it be better to do, to pay down the debt or to make an investment into the Heritage Trust Fund and earn interest on that same money?
I think the question was just effectively answered in the sense that I think you indicated that recent return has been higher in the Heritage Fund than paying down debt. We did not do any analysis as AIMCO, and so I don't want to speak for what was.
Yeah, so yeah, I mean, you concur with that. I mean, it seems reasonable to me that you would make a better.
Just math, but you know, it's more complicated than that, of course, through the chair, because the job is to forecast what the outlook is forward, as opposed to look at what has happened in the past. So we're now looking at that with the benefit of perfect hindsight, which is not a fair assessment.
Right. Yeah. No, I understand that, and certainly I just want to confirm what seems obvious to me, which is that making an investment into the Heritage Trust Fund with that same money actually serves the public interest better than the choice that this government made to not invest in the Heritage Trust Fund with that same money.
Comment on the performance that you had just alluded to. So how would performance or the fund had changed? Steve also mentioned it in his opening comments that the income is calculated over the year. So really, as far as this year goes, March 31 is really the date we're looking for for this investment income anyway. So we have some time for this decision to work itself out, and it's not actually impacting the fund or the investments of the fund at this moment in time. So the market value of the fund, the asset base, is still generating additional returns and that type of thing to our expectations at this moment. So as this decision to contribute or not contribute is on the table, the Heritage Fund is not impacted negatively. Does that help?
Yeah, okay. Thank you.
Great. Thank you very much for your answers. I understand. Who do we have? Oh, Mr. Hunter, you're next, please. Thank you.
My first question is just maybe some clarity on Mr. Egan's line of questioning. This is to Treasury Board. So when decisions are made, the policy is not made by you, it's made by obviously the government. But the question that I have for you is, and I think that this was already alluded to by Evan, is that it's a lot more complicated than that. The cost of the new debentures would be higher than the last, obviously, because of the cost of capital now. So in your analysis then, did you provide that to Treasury Board that there would be a higher cost, thus the carrying cost of debt to Albertans would be higher?
That's a fair point, and I would say it is. There is a danger in oversimplifying the analysis of deciding to pay down debt versus deciding to contribute to the Heritage Fund, and that's twofold. As you allude to, borrowing costs are significantly higher in the current fiscal environment, or than in the current global environment, in terms of bond yields, than they have been for over a decade. And so, yes, the analysis on the cost of debt would imply that the cost of issuing new debt is expensive. The cost of refinancing Alberta's existing debt stock at higher interest rate costs is significant. And then likewise, it's dangerous to assume that we can simply make a contribution into the Heritage Fund and instantly earn the return that the Heritage Fund has been earning to date. Deploying large amounts of capital into a fund such as the Heritage Fund requires a fairly significant process and takes time. So anything significantly large is not going to immediately begin earning the returns of the overall fund. So that does all complicate the analysis. But yes, when we are doing projections on what we expect our cost of borrowing to be going into the future, we look at the current and projected environments. You know, our economics and fiscal policy team provides forecasts of interest rates and global economic conditions that roll into our own analysis of debt servicing costs and the cost of debt. Likewise, we would look at investment income forecasts based on our current asset mix, based on our current expectations, based on AIMCO's long-term forecasts of asset classes, based on our own forecasts of those same asset classes. So yes, the calculations are not simplistic. We can't just say, oh, the Heritage Fund has earned 6% over 5 years. We would expect to earn that going forward. We would not. And likewise on the debt servicing costs, borrowing costs for provinces have been historically low for a very long period of time, and that is no longer the case. And not only are they high, they're now very volatile. So it's not a simplistic analysis in that regard.
As a follow-up, Mr. Chair?
Yes.
Thank you. So I just wanted to hear your opinion. Would you say that, I mean, obviously, hindsight is 20/20 vision. Nobody has a crystal ball for the future. But from your professional perspective, would you say that the cost of borrowing will be maintained as a high benchmark in the upcoming years?
In the relatively near term, in the current year, certainly yes. And the medium range. In terms of my expectations on global interest rates and provincial borrowing costs, I would say yes, it will be higher than we have seen historically.
Wonderful. Thank you for the answers. And I believe I have Member Phillips on the list next. Please proceed.
Thank you, Mr. Chair. So, quick question to TBF officials. When the Premier was campaigning, she repeatedly told Albertans that she wanted the Heritage Fund to change substantially, and she set, in fact, a monetary goal for that. The quote is, "Let's put it out there that we want to have a sovereign wealth fund that's 500 billion, generating 25 billion a year, so that we can eliminate income tax and eliminate corporate income tax." So to Treasury Board then, has any work been done on this goal? Any analysis on what it would take to meet it at all? And can you provide that to the public?
We have not specifically been tasked with meeting that aspiration. We continue to manage the fund based on our current legislative requirements and our current direction under the existing policies. We will respond to those once they are mandated to us.
So then, okay, I'll just follow up. So at the second quarter update, government projected 28 billion in non-renewable resource revenue. That's increase of 103% on NRR from budget. And we've seen big policy shifts in terms of Heritage Fund management from the former Premier to the current Premier. So I just want then a clarification that there is no government strategy when it comes to the Heritage Fund right now, or not yet, and that a record 28 billion in NRR has not precipitated the government to make or give any policy direction in terms of windfall revenues and how that surplus should be either invested or used to pay down debt.
I would say simply that's a fiscal policy decision outside of my mandate. I couldn't speak to it. It's a decision of the Premier, the Minister, and Cabinet.
So no forecasting has been done on that then?
Not from my division and not that I am aware of.
Okay, thank you very much. I think we'll go to Mr. Gottfried next, I understand.
I believe Emily Hunter still has some questions.
Well, I actually do, Mr. Chair, if that's okay.
Yeah, fine.
I have a question. In 2008, the financial crisis, most Canadians remember that. I'm sure you do as well. It was caused by overexposure to risky mortgage-backed securities and collateralized debt obligations that were branded as AAA debt. Can you expand on the steps you take to reduce the credit risk associated with debt securities?
Thank you. So let me start by saying in terms of how we approach investments and investment strategy on your behalf. So firstly, we're focused on looking forward rather than looking back. But again, as I said earlier, looking at history to learn lessons. So one of the things with respect to the credit exposures within the Heritage portfolio, we have an in-house credit team that does credit research to the extent we have any of those types of exposures within our portfolios. We do not use external off-the-shelf ratings, and one of the things, as you accurately referred to, was a AAA rating many of the CDOs at that time and securitized paper had. So we just as a design principle, we don't do that. We apply our own internal notional ratings. One of the benefits of using this approach, other than being quite hands-on with each of the issuer name, is also the ability to be forward-looking. A lot of the ratings that are provided by external providers tend to be backward-looking. And then, as we go through this process, we're focused on ensuring that the portfolios are diversified by sectors. There's deep expertise in those areas that we're investing in. And then, lastly, and this is something we've been focused on over the last 2 or 3 years, is integrating the work that the credit portfolio management team does with our product risk teams. And there's a great amount of work and a list of attributes that the risk team also tracks to ensure that the credit portfolios are suitable and remain suitable as part of the portfolio. I'll give you, lastly, one example and one sort of area where the Heritage Fund gets exposure to credit, and that is the private debt and loan component of the Heritage portfolio. This is an area that's developed over the last roughly 10 years, and the reason why it's been quite attractive for investors such as yourselves is the fact that as the bank balance sheets have shrunk over the years, the ability for investors to step in and capture those economics has been quite profound. So at the moment, the private debt and loan portfolio roughly has a yield of 9%, which is quite attractive, notwithstanding even the current elevated rates of inflation. Secondly, we get earned origination fees, which could be 2 to 4% on those transactions. And thirdly, just from a near-term perspective, we are looking at the lower risk spectrum, even within the private credit space, so most the first lien type of exposures rather than the riskier exposures. So all of that to say, there's a wide range of things we do, both from research, both from organizational sort of structure in terms of integration with risk, as well as the new opportunities that allow us to be quite careful and thoughtful in managing credit within the portfolio.
Mr. Siddall, did you want to add to that?
I'm going to give a very extensive answer, but I talked about expanding capabilities in our team. We just hired the gentleman who ran this business for PSP at AIMCO. His name's David Scudolari. PSP was by far the largest private debt provider in among the Canadian pension funds, and he was the number 2 person there. We've just been able to hire him to lead our business, and so this is an area where, as the Heritage Fund indicated, as the officials indicated, they're increasing their allocation, or increasing their limits, I should say, to potentially take advantage of opportunities such as those that Amit mentioned are existing in the market right now.
Thank you. Follow-up? No follow-up? I believe Ms. Phillips again, please. Thank you.
Thanks. So we just heard from TBF officials that returns from the Heritage Fund have been higher than debt servicing costs in the past. But I'm wondering if we can follow up either in writing with the analysis or now if it is at your fingertips. Because what the forecasts for this comparisons are now, given that officials just said that debt servicing has gone up and is expected to remain elevated in the medium term. And so the reason I'm asking, the background is, of course, with 28 billion in natural resource revenue windfall, the public should probably know what the best return on investment is in terms of prudent management of surplus.
Well, certainly those numbers are all available in our quarterly updates, both for the province and for the Heritage Fund. And in terms of debt servicing costs going up, I would isolate that to say the cost of borrowing is going up. There's a few other elements to debt servicing costs that make it not directly correlate to simply rising interest rates. There are amortization expenses and various other costs associated with borrowing that go into debt servicing costs that will make it fluctuate a bit. But certainly we can pull the latest numbers from the reports and provide them to the committee.
Okay.
So just to be clear, just to follow up then, to be clear, the forecast for returns on the Alberta Heritage Fund and the forecast for debt servicing costs, those are available in the fiscal plan? I'm not sure that they are.
Those would be in the budget. They will be in the budget. We can point to those. We can only provide things that are publicly available at this point.
And I think that the debt servicing costs component of everything is very difficult to explain based on the timing of our borrowing as well too. The government was in a deficit position before, so the need to borrow was there. Therefore, we were borrowing at those current rates. It depends on if we're actually borrowing when the costs are high, which impacts debt service ratios. Also, the debt service costs are pursuant to what we've also financed in the past. So we have some 30-year debt on the books at very low rates. And so that also brings the average debt servicing costs down. So there's a lot of components that we have to look at when we look at that number. And again, these are numbers that you will find in the fiscal and budget updates as far as what sort of transpired. But the forecasting of it has a lot of different components that, I mean, that's a difficult one. So.
Okay, thank you very much. Interesting questions. I believe we're going now to Mr. Gottfried on the list. Thank you.
Yes, thank you, Chair, and thank you to the fund managers here for presenting and giving us some very detailed information. Just on page 14, the report discusses some of the foreign denominated assets in the portfolio. I'm just wondering, obviously there's a lot of volatility, geopolitical influences these days, a lot of focus on energy security, food security. How have the Canadian assets performed the foreign assets performed compared to Canadian assets? And maybe more broadly, are there any variables that you look at in expected performance of the assets, the foreign assets that you consider before deciding to invest domestically versus internationally? And I may have a follow-up to that as well. Thank you.
Thank you for the question. Let me start with the second question first and come back to the impact of the performance of the foreign denominated assets. So when we look at investments, whether foreign or domestic, but certainly those outside Canada, we're looking at what the expected returns might be. So the attractiveness of the investment itself, the risk, the cost, to get into the transaction or get away from, sell out of the exposure. Beyond that, we go through the usual due diligence filters depending on the country, depending on the geography. And then lastly, the pricing, et cetera, in the market at the point in time. So all of that to say it's a wide set of considerations when we look at investment opportunities outside Canada. And just to give you a bit of color and a flavor in terms of what those types of things may look like. So when we look at mortgage opportunities within North America, so there are certainly aspects or parts of the Canadian mortgage markets that are attractive, but it is a relatively small market, and given the size of the institutional investors such as yourselves within Canada. So we would look at areas within the US where we invest in, but ensure that the cost of currency hedging, net of that, the opportunities are still attractive. So that's number one. Number two, in terms of your question around, how have the international investments done? So if just from a currency perspective, the general, the settled sort of conventional wisdom on the academic research and practitioners is that over long periods of time, currency impacts are net zero. They sort of even out. However, over shorter periods of time, that impact can be material or certainly noticeable within a portfolio. So over the 12-month period ending end of September 2022, the Canadian dollar had weakened by 9% relative to the US dollars. So to the extent that you had exposure, the Heritage Fund had exposure to US dollars and foreign currencies, those exposures did well just in Canadian dollar terms. Thank you.
Thank you. A follow-up?
Supplemental, if I could, Chair. Thank you for that answer, and that kind of explains obviously the approach. But moving back to page 12, the report discusses some of the use of the forward contracts. Obviously, there are geopolitical influences that can arise, and we want to make sure that we're protected. So I know that you have contracts that were referenced on page 12 with regard to protecting against exchange rate fluctuations. So what percentage of the foreign denominated assets, and how do you protect that? I know you said in the long term it is a net zero impact, but in the short term, if you are investing in perhaps more volatile markets, how much do you use those contracts to protect from currency fluctuations?
Yes, so as of end of September last year, the foreign denominated assets at the Heritage Fund were roughly $12.5 billion, so about 67% out, and roughly half of those were hedged, so currency hedged, excuse me. So said another way, of the overall portfolio, about a third of the portfolio is exposed to foreign exchange impact. As I mentioned in my previous response, near term that's been positive, but over time, the impact is not muted. This moving over to foreign exchange markets. So the recent estimate from Bank of International Settlements, they noted that $7.5 trillion of activity happens in the foreign exchange market every day. It's every day, $7.5 trillion. So it's a deep, rich market. And the way we engage on your behalf and other clients in this market is to utilize pretty well-defined processes, use electronic platforms, which is how a lot of that activity happens now. Certainly for smaller transactions, use 10 to 12 counterparties in engaging in that. And then the last bit where we've started, we're doing research at the moment, and we'll be engaging with clients, is also thinking deeply about the implication that the usage of forwards have on the overall liquidity of the portfolio. So that's something that we're focused on. Again, thinking about, thinking from a lens where the markets are going and what liquidity needs might be relative to where we've been in the past.
I can just elaborate on that because it's an important point Amit's making about, you probably think we should be hedged all the time because we want to eliminate risk. Well, if over the long term there is no risk, if over the long term foreign currencies tend to mean revert or just behave in a way that there's no risk, then we're spending your money unnecessarily hedging that risk. And better we keep that liquidity to take advantage of market opportunities. So we're doing some research, as Amit said. This is, again, thinking about the money from a client portfolio point of view instead of an asset class point of view. It's enabling AIMCO to go down new paths or to advise its clients on potential new paths.
That's great. Thank you very much.
Mr. Egan, yours, this is the floor.
Well, thank you. Thank you, Mr. Chair. And I just want to go back to this discussion around whether to choose to invest in the Heritage Trust Fund or to pay down the debt. I mean, I think it goes to the heart of the responsibility that we have here in this committee, and indeed the heart of AIMCO and TBF in many ways. I didn't get a clear answer, but I'll just try it again. Are you suggesting that it's more prudent at this moment to not be investing in the Heritage Trust Fund, but rather to be paying down investments or paying down debt? Is that what I'm hearing here this morning?
I'm not speaking to either decision. We provide advice on both the cost of debt and the expected return on the Heritage Fund. The broader fiscal policy decision still rests with government. We are currently mandated to manage the fund per the Act and per all of the policies that are in place. Adding to the Heritage Fund would be a change in that policy and would require legislative changes that have not yet been made. So we are not really in a position to speak to that.
Well, I mean, given that part of building the budget for this province involves dividends or investments or returns from the Heritage Trust Fund. I mean, that's part of how you build a budget. I mean, I know when having built several budgets together in the cabinet as government that you depend on those investments and you depend on the security of the Heritage Trust Fund. And considering then that with all the inflationary pressures that we've talked about here this morning on investments just globally and specifically on our Heritage Trust Fund and the importance of those interest returns into our budget, I think that we need to rely on expert advice to let us know whether we should be investing in paying down debt or we should be paying a portion of considerable surplus that we have right now into the Heritage Trust Fund. I mean, that's where the Heritage Trust Fund came from in the first place and was generally considered to be a prudent move, right, to put non-renewable fossil fuel royalty money into a long-term fund. And so here we are, and I take the responsibility of being in this committee as overseeing the Heritage Trust Fund and activities. We rely on expert advice to tell us which is the best way to go. And I think Albertans want to know that too. And so, are you saying that it's a political decision, and it's not a decision based on the expert advice that we get from people like you?
No. What I'm saying is that it currently is a decision outside of this committee. This committee is tasked under the Act in its current form to consider the best interests of the fund. What you're asking about is changes to future fiscal policy with respect to debt repayment or contributions into savings. which have broader ramifications across the board from a fiscal policy perspective and are beyond the advice that we provide. We will provide the best professional advice to the government on the difference between the different costs and benefits expected between paying down Alberta's debt stock versus putting money into the Heritage Fund. But there are broader fiscal implications with respect to surplus and deficit management that are beyond the mandate of this committee and of my division, my branch, with respect to management of the fund.
Thank you very much. Ms. Lard, please.
Thank you, Mr. Chair. I wanted to talk a little bit about liquidity risk, since we've been talking about risk management, and given the climate that we've been in the last few years with war in Europe and pandemic and supply chain issues, I think market corrections are potentially still coming. And so I just wanted to ask, on page 15, it discusses the liquidity risk associated with the fund's financial liabilities. Does the fund engage in margin trading or other activities that amplify this risk?
So the fund utilizes leverage in certain areas, similar to again institutional peers and other Maple 8 pension plans in a prudent manner. The leverage used within the Heritage portfolio and portfolios of other clients are equally are utilized both to manage risk as well as to add value, add excess return in both of those categories. And thirdly, and perhaps most importantly, outside how we utilize leverage, is the monitoring and reporting of that leverage to all of our clients. That is something that is a big focus of ourselves. The metric in particular that we report for our clients is the SLCR, or the Statutory Liquidity Credit credit ratio, and at the last report, that number was 153%. Earlier this week, it was 170%. And just to add a bit of context around that, that's a conservative measure of what a portfolio, such as the Heritage Trust Fund portfolio, how it would be impacted under pretty severe market scenarios, and particularly the ones we use take a leaf from the GFC, the Great Financial Crisis in 2008, and assumes equity markets are down 30%, the credit spreads widen, the Canadian dollar weakens. And so in summary, we look at the liquidity of the portfolio, and to the extent those liquidity needs are driven by leverage, very, very carefully, very, very thoughtfully, and to just allude to our previous response, part of our research and client engagement the first half of the year around foreign exchange, for example, is focused with an eye on liquidity as well.
Thank you. And a follow-up, Mr. Chair. I just wanted to say some of the questions this morning, although important questions to ask of government, I believe are outside the scope of this committee. And so part of the reason I wanted to ask about risk management is that that's within the scope of what this committee is looking at in terms of managing the fund versus the policy decisions of government. So I just wanted to ask, I guess, a more pointed question in response to your answer. Do you believe there's any risk that the fund may not be able to meet its obligations if there is in fact another extreme market correction?
So no, we don't believe that the Heritage Trust Fund is under risk of not being able to meet its obligations.
Wonderful, thank you. We're back to Member Phillips.
Yes, thank you, Mr. Chair. Thanks for your patience there. At this meeting, it was an annual meeting of the Heritage Fund. there was a review of the investment strategy of the fund announced. I believe that was in December of 2020 or perhaps 2019. We have heard then, as we followed up on this matter, that changing circumstances have caused that review to restart. Now it's been a few more months. So I'm wondering if Treasury Board and finance officials can update us on the status of that review, whether it has restarted, what are its anticipated timelines, and any other updates on the direction that have been given around that review.
Yeah, happy to respond to that. I believe I mentioned earlier that the review is currently underway. We have reviewed the asset mix and investment policies over the past year and a half, or well, since originally mandated. We have conducted some modeling and stress testing using AIMCO's staff and AIMCO's systems. We are currently in the process of constructing an RFP to engage with an external service provider to further test and stress test and make recommendations around a future asset allocation for the fund, all within the current mandate of the fund and encompassing any changes that may come to that mandate. That RFP should be posted in the coming months. It will be on the public site, and more details will be available when that is out. But the review is currently underway internally at Treasury and Risk Management, assisted by AIMCO's staff and systems.
Follow up?
Yeah, sure. Thank you. So is it anticipated that that review will be complete prior to the annual report being available to the public in June? Or are we looking more into the 23-24 fiscal year for completion of that review? And when will the elements of it, will there be any interim elements shared with the public or with this committee?
It will likely not be ready for the annual report. I would think it would be more into the end of the fiscal year, end of calendar 24, that we would be looking at results. We would not be in a position, and it would not be industry practice, to share any of those results prior to their finalization.
Okay, thank you very much. Mr. Hunter again, thank you, please.
Thank you, Mr. Chair. So this question is to AIMCO. I had asked earlier a question about some of the problems we saw back in 2008 with the AAA debt. Well, supposedly what was branded as AAA debt didn't turn out to be so. So my question to you is found on page 13 of your report. It discusses the credit risk of debt securities in your portfolio. I see that the percentage of investment grade debt in your portfolio has decreased while the unrated debt has increased since the last quarter. So I get that possibly that could increase, that rebalancing could increase returns. But is that going to put us at risk in the near future?
The increase in the decrease in the investment grade and the increase in the unrated is primarily driven by the higher allocation, higher investments in the private debt and loan market that I alluded to earlier. And given the nature of those markets, they tend to be unrated externally, but we do have an internal process, as I mentioned earlier. Secondly, from the overall portfolio perspective, one of the things we discussed with clients as we were looking to, as we saw opportunities in that space, was to be also careful and thoughtful about how we would fund that trade, if you will. So if you were putting in $1 here, where does the dollar, if you will, comes from? And so as we were looking at that, so part of the funding side of the trade for many of our client portfolios was from the equity side. So what that does is, what it does in the portfolio is certainly expose the portfolio to slightly more credit risk, but takes away, if you will, a more riskier asset class, to put that trade together. And what that does at the overall, therefore, portfolio level is you're able to manage the overall risk in addition to all the controls one has around the specific credit transaction.
Just one follow-up, Mr. Chair, if I might. So are you going to increase that low-grade debt percentage in the future, or is that going to stay what it is right now?
So at the moment, we are looking at opportunities in that area, and as was mentioned earlier, now we have, to the extent we have wider range, we do think that's an attractive place for investors such as the Heritage Fund to be exposed to.
But it would be an erroneous comparison to call private debt that we underwrite the credit worthiness of the same as something represented by collateralized mortgage obligations that people didn't understand and that did not have proper credit support. We understand these credits.
Mr. Chair, if I could just clarify that point.
Once.
Okay. I did want to say that, look, I wasn't making a comparison, but I was saying that a good general isn't a good general because of what he learned from the past, but predicting what's going to happen in the future. So I just wanted to make sure that we're not tripping as we saw in 2008.
Yeah, indeed. And in fact, what Amit described in the shift from equity investments to private debt investments is actually a de-risking move, right? Because we're moving from something that's more risky, equity, to something that's less risky, debt, even if it has a higher risk than investment grade. And these are unrated, not necessarily low-rated securities. They're just not rated.
Clearly clarified. Mr. Egan, the floor is yours.
Well, thank you. And just further to that, talking about forecasting to the future, if there's an example of a asset class that might be mispriced at this juncture, I'm just curious to know if there's an asset class that might be showing as overvalued and an asset class that might be showing as undervalued.
That's a tricky. You'll get 10 opinions from 10 smart people on that, and I'm not going to volunteer my own subjective opinion, and I'm going to encourage Amit to not do the same. So yeah, I mean, we have this debate among ourselves, but it's really important for me to emphasize this, that when we have these discussions, we're thinking 10 years, like we're thinking over a 10 or 20 year period. Versus a government funding decision that may be over a year. So the time frame that you're discussing is actually an important component in making an investment decision. It's a crucial component.
No, fair enough. I mean, we have sort of both of those things built in structurally with the Heritage Trust Fund that it supersedes electoral politics usually, and then and has existed for almost 50 years, I suppose, right? And so. You build your investment structures on a longer time frame. Is that what you're trying to say to me?
Yeah.
But then, I mean, it just seems really volatile right now, right? So you have to look at asset classes categorically, I suppose, but you also just aim for something specific. Like for example, I think about the London airport, right? And so it's undergone a temporal restructuring with COVID, right? And then it's bouncing back. Like, maybe can you use that one as an example? Like, what's happening with that investment?
Mr. Chair, with respect to the gentleman, that bait I'm not going to take. It's just like it would be so speculative.
Yeah, it's speculative.
It's speculative.
Yeah.
Now we did reinvest a little bit of money in the London City Airport last year. How much was it?
I don't know the specifics, but if I can add to what Evan was saying, and it's a theme that you'll hear us coming back to again and again, sort of focused ahead of us. We've talked enough, about private credit and loan. Partly that is the economy slowed down. Typically, we've seen that in 2008. We saw that in Europe, early part of last. No forecast here. What you see is that the credit and the liquidity sort of shrinks, and then there's an opportunity. How well one does the forecasting is very hard, very difficult, and a mug's game more often than not. But the ability to be thinking about, where the economy and the broader trends are. Transition finance, we think longer term is quite attractive. It's not a trade that's here and now. That's the next 3 months or next 6 months. These are long-term changes which give rise to risk, but give rise to opportunity, and that's where we're focused our energy on your behalf.
And in an effort to be not non-responsive, we had a conversation yesterday with the head of real estate about the U.S. market could be very distressed, and therefore for us, as a long-term investor, this is where we play to our edge, right? We're a long-term investor. We can stick through markets that are choppy and take advantage of distress such as in private debt and in the U.S. real estate market if we find those opportunities.
Thank you. Wonderful, thank you. So I think we'll return online here. Member Pond, I think you're next on the list.
Thank you, Chair. Can you hear me well?
Absolutely, please proceed.
Thank you so much. Interesting to listen to all this. This is my first meeting in this the committee, and we talk about loss to manage, how to manage the risk. To talk about how it's going to impact the credit rating, and this is questions. It's just about that. Recently, that we watch the news, the collapses of the FTX, crypto exchanges, which is a highly the rising associated with the investments in this is a highly volatile asset. And one of the investors in the FTX that was the Ontario Teachers Pensions Fund, and who lost nearly about $100 million in the collapse. So there's a couple questions here. Do you have any cryptocurrency holdings or other high-risk investment? And are there any plans to expand the investment into this type of asset in the future? Thank you.
Yeah. Now, other high-risk investments is, you said a mouthful there. There's a question of what some people have. Some people think equity is high risk. Some people think private debt is high risk. But I'll just answer the narrow question. We don't have any investments in crypto or anything that has to do with crypto, and we've scoured the portfolio to be sure of that.
Follow up?
Can I ask one more question, Chair?
Please, yes.
Thank you. So as an investment, you're always looking for the better ROI for sure. And my question is, sometimes we are more aggressive, active, persuasive funding management, which is to offer a better result as what we also looking for. And continuously that the debate in investment cycles. So can you expand on what percentage of your portfolio is actively and managed, and why this is the correct approach? And also, has this approach allow you to beat the average market gains, as we always want to have a high investment, high return on rate of return, but a lower risk? Thank you.
So, thank you for the question, two-part answer. So, currently, almost all of the portfolio is actively managed. I preface that with a big portion of the portfolio, so think private equity, think private debt and loan, infrastructure, etc. None of these asset classes have industry-wide benchmarks, and therefore the notion of passive investing is a little fuzzy at best and unclear for the most part. So those types of investments are inherently active in nature, given those asset classes. On the public asset side, so primarily in public bonds, public equities, we utilize an active approach, but have introduced indexed equity vehicles on the platform over the last 12 months or so. The last part is in terms of the approach that our clients will take in future in being able to utilize those types of exposures is always a function of return, risk, cost, liquidity, etc. But for the moment, the Heritage Fund is managed in an active manner.
Okay, thank you very much. Now, I'm getting signals we may be coming close to the end of our question, but for the record, Mr. Egan, anything more from your side? No? Allard, anything more from your side? No? Well, thank you. That's even questions. So, gentlemen, ladies, thank you both, all of you, for your attendance, for being here. You're free to leave at this stage, or you may stay if you would prefer to listen to the rest of the committee meeting. It is public, so you're welcome to stay if you choose.
Chair, we have money to invest. We're going to get back to work.
I'm sure, yes.
Thank you very much.
Usual response, but thank you all for being here. Appreciate it. And this is good because we do have a couple of more agenda items that may go quickly or may have some questions. So, yeah. So I will look for a member to move a motion that the Standing Committee on Alberta Heritage Savings Trust Fund receive the 2022-23 second quarter report on the Alberta Heritage Savings Trust Fund. Anybody like to move that? Member Allard has moved that motion. Where are we at? Questions or comments? None? In the room, all those in favor? Any opposed? None. And online, all those in favor?
Aye.
Aye.
And I don't believe there would be any opposed since you all said aye. So that motion is carried. Thank you. So now we need to talk briefly about the review of the past public meeting from 2022. The Alberta Heritage Savings Trust Fund Act, the Act requires that the committee hold an annual meeting, I'm sure you're all aware of that, with the public to inform Albertans about the status of the fund and respond to questions. That meeting was held here in the building on October 27th of 2022. The 2022 public meeting was the first since 2019, actually, that was able to be held without any heightened health restrictions. The public was invited to attend in person, and the meeting was broadcast on Alberta Assembly TV, live streamed on the Assembly website, on Twitter, on Facebook, and YouTube. A document from LA Communications was posted on the internet website, which provides a breakdown of the public interaction with the committee that occurred during the public meeting, as well as the advertising summary. I trust you've all had a good look at it. At this time, I'd like to call on Rhonda Sorensen to, with LAO to provide an overview of that report and some additional information regarding the broadcast and public response to the meeting.
Thank you very much, Mr. Chair, for that overview of the 2022 annual meeting. I would just like to add a few comments a bit more specific to the communication summary document that was sent to you. The committee members well note that we were ever so slightly over the estimated costs for the entire campaign, largely due to an adjustment made to the advertising plan that included a significant province-wide print campaign. We did make some revisions within that campaign to mitigate some of the cost increases we were seeing, but we still weren't able to quite make that target. I won't go into detail on each of the various components within the plan because you do have the report in front of you, but I do want to highlight some of our successes, including a thank you to the former chair, the chair at the time of the public meeting, who had done some media French translation interviews. So in addition to some of the media that we were able to garner before the meeting, he did a post interview that was translated into French that spoke about the public meeting, this committee, and all of its hard work. In addition to the media coverage, we were also able to attribute nearly half of the 2,680 visits to the committee website directly from the social media and digital advertising. We continue to see solid engagement through those efforts. So because of that, we will be recommending to the next committee that we increase that and put most of our focus towards heavy digital engagement for next year's public meeting. Beyond that, I'm happy to take any questions from the committee and hopefully can provide some more in-depth insights if you require them.
Wonderful. Thank you very much, and thank you for the analysis. I did notice your recommendation in there. It makes sense to me. But members of the committee, any questions or comments on what you've just heard? Wow, everybody's, you must do a good job. So, as noted, there is a recommendation in there, but I think it can wait till the appropriate next meeting and planning, which will happen not too far distance in the future. So, no comments, no questions. I think that we can proceed then. To talk about the committee's annual report to the Legislative Assembly. So, members, Section 6.4C of the Heritage Savings Trust Fund Act requires the committee report to the Legislative Assembly on whether the mission of the fund is being fulfilled. The last report to the Assembly was made on June 8th of 2022, which covers the activities of the committee in the 2021 calendar year. Please note that I said calendar year, okay? But the Act states that the fund's performance is to be reported following each fiscal year, not each calendar year. And that was the practice until the end of the 20th legislature, beginning in, and then the transition to 2015. So an election year at that time as well. At that time, the two reports were produced. At that time, two reports instead of one were produced, one covering the period before the election and another covering the committee's 2015 activities after the election. Since then, the committee's reports to the Assembly have covered the calendar year. I know that some have looked back to try and figure out if there was any discussion about why that switch was made. Nothing has been uncovered. Thank you. I think it is to our legal team that noted that the Act actually states fiscal year, but we've been acting on the calendar year for the last few years. So to right the ship on this, this year's report will cover the committee's activities for the 2023 fiscal year, and will also include the quarter between January and March of 2022. So actually 5 quarters will be covered so that there are no gaps in our reporting. The committee clerk will prepare a draft report which will be distributed for the committee's consideration at next meeting. So first of all, I don't know if either the clerk or Ms. Robert, if you have any further comments you want to add to that whole little bit of chaos there or not?
No, I think,
Yeah, you covered it.
Okay. So questions about that discussion? Any concerns, any issues, any questions to our officials here? The intent is to go back to what the Act states as a fiscal annual reporting rather than the calendar annual reporting. Okay, well that makes this fairly simple. So if yes, please proceed.
Just a question. When the Act states the fiscal year, are they talking about the government fiscal year? Does the fund have a fiscal year that is actually Jan 1 to December 31st by any chance?
No, my understanding is that they are both the same fiscal year, March.
Thank you.
Any further questions or concerns raised? If not, we will proceed as I have outlined. Hearing none, I think that then that is in the record and that's the way we will proceed. So thank you, clerk. So the report will be prepared accordingly for our next meeting. So that was fairly simple. I didn't know if there would be questions or not. Other business, I'd like to note that the committee received follow-up responses from Treasury Board and Finance and AIMCO to questions that were asked in September of 2022. They were made available to members on the committee's internal website. Are there any other issues for discussion before we wrap up today's meeting? Anyone?
Sorry, point of clarity. Was that done in 2015 by committee motion?
No, it was not. There is nothing in the record that indicates why that happened, is my understanding.
I see. Okay. So it doesn't have to be changed by committee motion?
Correct.
Okay, thank you.
I think, sorry, Mr. Chair, I think the reason they did it was they wanted, because there was an election, they wanted the current committee to only, to tie up their work and finish it. And then the new committee then did their reporting on their work. I think that would, it wasn't really explained well in the transcript when I look back, but yeah, like the chair said, it always was done on the fiscal year prior to that, so I think this is the best way to get us back.
State fiscal.
It does, yeah.
I just wanted to make sure it didn't have to be changed by.
Yeah, correct. I don't think there is requirement for an official motion to comply with the act. Okay, so that should wrap up the business for today's meeting. The date for the next meeting will be at the call of the chair after the Heritage Fund's third quarter report is released. I expect that will be sometime toward the end of March after the estimate review process is complete, but before we find ourselves in another election. So expect a meeting somewhere toward the end of March. And if there's nothing else for the committee's consideration, I would call for a motion to adjourn the meeting. Mr. Hunter? All in favor? In the room? Online?
Aye.
Any opposed? Everybody's approved, so there's no opposed. Thank you, folks, and the meeting is adjourned.